Welcome to the Canadian Investment course, Session 16, Measurements. Please review slide 2 and read it. Terms of use and disclaimer. Economics sort of is like the weather. In fact, the cartoon says, pull the weather thing out, and the economics guy puts it in, mind if I borrow your chart? So, observing two sets of measurements. There's the market sentiment measurements and economic measurements. This lesson will introduce and define a number of measurements that portfolio managers use in determining their investment choices. The U.S. economy. We'll defer to the U.S. data for this lesson. As a Canadian, our market reacts to U.S. data and U.S. markets. It's a fact of life. Gross domestic product is the GDP, broad measurement of the nation's overall economic activity. GDP can be calculated using the following formula. GDP equals C plus G plus I plus NX. C is equal to all the private consumption or consumer spending in the nation's economy. G is the sum of government spending. I is the sum of the country's investment, including business capital expenditures. And NX is the nation's total exports, calculated total exports minus total imports. You'll notice that if you see the chart at the bottom of slide 6, it floats sort of between 0, a little bit negative every once in a while, and 4 or 5%. How does it stay so smooth? And then look at the unemployment rate. Unemployment rate recently has dropped to lows. Typically, full employment is considered to be somewhere around 5 or 6% because there are a lot of people who, for whatever reason, never find employment. So the U.S. real retail sales growth, as you can see lately, it's been fairly flat. 2.71%. The mean is 2.03, the median is 2.4, minimum's minus 11.6, and the maximum's 8.64 in March of 1994. The low was in December 2008. So look at U.S. median income growth. This is an important chart. Notice how recently it's fallen to close to all-time lows. 2010 was the low point, but median incomes have fallen significantly. And if you look at them going back to 1980, they've fallen in a very important way. This is not good for the U.S. economy long term. Then there's the Schiller Home Price Index, which went crazy in around 2000, in the early 2000s, collapsed in 2008 and fell to a bottom around 2011 and is kind of recovering now. So this is an important factor to bear in mind too. The way they take it into account is historic prices are inflation adjusted in 2017 dollars, but they're not seasonally adjusted. Some of the measurements described in coming slides may be new to you. The investment industry tends to have a positive bias and build a case to be invested at all times. So you have to learn the long-term measurements presented and understand what they mean and be able to see through some of the hype. Let's start with the S&P 500 real earnings growth. Well, S&P 500 earnings growth as of December 2016 shows 7.81%. That sounds pretty good. But what about sales growth? Well, sales growth for December 2016 was only 0.72%. What about real price earnings growth? This is the price earnings ratio. In other words, how much has the price earnings ratio gone up? Ooh. Current price earnings ratio is 25.26%. That says the market's not cheap. And what about market cap to GDP? This is the Warren Buffett valuation indicator. Well, He says sell stocks if it's above that top red line on right there. The long-term average is below there, and he'd have you buying stocks at the lowest red line. Look at where they are today. This says Warren Buffett's not a big buyer of stocks in today's market. Warren Buffett's known to be a pretty wily investor, a value investor. And look at the Shiller price earnings ratio, 28.46 times. The high was in 1996 or closer to 2000 probably, maximum 42.2 when the dot-com boom was going wild. But clearly they're high relative to the long-term average being 16.7. So the market's overvalued by this indicator as well. S&P 500 dividend yield. Well, the dividend yield is an indication of when stocks are cheap or expensive, because when the dividend yield's relatively low, it means that stock prices are high, because companies try to keep their dividends relatively constant or grow them if they're doing well. So if the dividends are growing but they're low in percentage value in relation to the stock price, it means the stock price must be fairly high. Then there's Hussman's non-financial market capitalization. So this is non-financials. And you can see that they're very high as well. So the market capitalization of non-financial stocks is very healthy. So each month, Trusted Wealth Professionals will update a few of these measurements in our Golden Swan newsletter. You're welcome to sign up and for free for this monthly newsletter. This will help you rule your wealth, because each time one of these slides is presented, it will also be explained. That's the end of segment 16. Thank you for listening.